What if trying to seize $210 billion from an adversary, an act that's supposed to deliver maximum financial pain, is actually the real story of Europe's escalating financial and legal crisis?
It's the ultimate financial boomerang. It really
Yeah.
is. The sources we've been looking at suggest the move that was intended to punish Russia is now tying Europe in, well, absolute knots.
Knots, how so?
Legally, financially, geopolitically, the core issue isn't just the money itself, but the colossal risk it poses to the entire architecture of global sovereign debt.
And that's exactly what we're diving into today. We've been examining transcripts and some pretty high-level reports detailing this absolutely intense global financial struggle happening right now. Our mission is to really analyze the standoff over that $210 billion in frozen Russian assets.
It's a huge standoff. You have conflicting demands from the EU Commission versus the European Central Bank.
Right. And then you have the sudden, really sharp withdrawal of U.S. financial support for the conflict and the severe, concrete countermeasures that Moscow is preparing. We want you, the listener, to walk away understanding how this one single legal maneuver has metastasized into an existential threat for European financial stability.
We're seeing a high-stakes collision. It's where political necessity is running headfirst into international banking law. The complexity here, it's not in whether the EU wants to use the money. I mean, they clearly do. But the staggering cost to their global reputation and financial system if they go ahead.
If they violate the treaty.
If they violate the very treaties designed to protect their own currency.
Okay, let's unpack this. Let's start with the sheer scale of the money and the deep legal hole Europe finds itself in. We're talking about approximately $210 billion worth of Russian central bank assets frozen since early 2022.
And here's the key legal distinction that makes this whole thing so volatile. The EU is officially designated only as the custodian of this money.
The custodian. That sounds like a very specific legal term.
That custodian status is everything, legally speaking. The reports we've seen, they all emphasize that at some point, whether it's through a peace settlement or a legal challenge, Russia will absolutely demand those funds back.
And if the EU has already spent them,
they can't repay. And that inability to fulfill an obligation of custody would be, in the words of one transcript, a gross violation of international law. It would turn a political statement into a decades-long legal nightmare.
It sounds like a problem that was, well, entirely foreseeable, and yet the EU Commission seems determined to find a way around it. And they looked immediately to the European Central Bank, the ECB, to act as their insurance policy, right?
They did. And this is where the desperation really becomes clear. The EU Commission went to the ECB, requesting what was described in the financial press as an insane 140 billion euro backstop.
A backstop.
They wanted the ECB to act as the lender of last resort for Euroclearbank, which is the key clearinghouse holding a lot of this frozen cash.
So, essentially the EU was saying, we want to spend the Russian assets now, but if Russia sues us in 5 years and we lose, ECB, you pay the tab.
Exactly that. They were looking for a sovereign guarantee from the central bank. They wanted the funds backed by the institution responsible for the very integrity of the euro.
But the ECB president, Christine Lagarde, she publicly rejected this. And it wasn't a soft no, it was a firm, uncompromising refusal. Why so rigid? Is the legal risk genuinely that high?
For the ECB, the risk is not just legal, it's systemic. Their rejection was based on 3 critical pillars. First, they firmly believe the move is illegal, period. Violating international treaty law compromises their own mission.
Okay.
Second, they warned that introducing such a massive contingent liability, a 140 billion euro sudden debt, would immediately fuel high inflation in the eurozone. It would destabilize the economy.
And the third point?
The most critical one. They stressed that acting as a political guarantor for seized assets would instantly destroy central bank credibility. Lagarde's stance was uncompromising. We will not violate the treaty. For the ECB, you see, independence and adherence to the rule of law is the only real asset they have. They refuse to trade it for political convenience.
So with the central bank roadblock firmly in place, the EU is still considering using the money. Let's shift now to what our sources are calling the boomerang effect, the tangible financial consequences of crossing that line. What happens if they do it anyway?
The blowback is immediate, and the analysts we're reading suggest it will be generational. Russia has already issued these severe warnings that Europe would face, and I'm quoting here, 50 years of litigation.
50 years.
We're not talking about a quick court case. We're talking about Russia suing every single entity involved, from custodians like Euroclear to the individual governments, tying up financial mechanisms across the entire bloc for decades. The material suggests this legal fight would haunt Europe for half a century.
And that legal risk, that threat of just endless litigation, that translates directly into a financial penalty that hits Europe right now, even before the money is spent.
It does. Confiscation drastically, and I mean drastically, compromises the perception of the euro and, crucially, European sovereign risk. When a major global economy just arbitrarily seizes assets, it sets a precedent that damages all other economies in that bloc.
So how does that look from the perspective of a major global investor, let's say China or Saudi Arabia or one of the BRICS nations?
They immediately ask, if they can seize Russia's money, why not ours? I mean, these countries hold vast reserves in European instruments and sovereign debt. A lot of it is housed within the very same clearing systems like Euroclear.
Right.
So if they see the EU violate the basic rules of custody and property rights, buying EU bonds instantly becomes viewed as a big risk, maybe even hazardous. They're trying to avoid a potential Russia 2.0 situation down the line.
So this isn't just some abstract concern about reputation. This reduced demand from major global players is hitting the bond markets right now.
Absolutely. The financial analysts we reviewed are very, very concerned about the real-world impact. Even with the ECB recently cutting interest rates to try and ease borrowing, we are seeing bond yields in major countries like Germany and France rising sharply.
So what does that mean in simple terms?
This upward pressure on yields, it just signals higher risk, and it translates directly into higher borrowing costs for businesses and governments all across the EU. It forces higher taxes or tighter budgets, precisely when these economies need stimulus.
Which brings us to the third major factor driving all this chaos: Europe's deep economic desperation, which is happening right as America sharply withdraws financially. You really have to understand the level of crisis in Europe to see why they're even thinking about these legally destructive actions.
Europe is in a profound economic bind. Many key EU countries, including the traditionally stable economies of Germany and France, are facing a major financial crisis. It's rooted in industrial collapse.
Industrial collapse.
Manufacturing output is down, they're struggling globally, they're selling less, partly because of geopolitical tensions, and critically, they're importing massive amounts of expensive energy, a lot of it from the U.S. Analysis from Brussels confirms Europe's traditional trade surplus is just vanishing. Demand is plunging.
And we have some pretty clear anecdotes that underscore this desperation. Our sources noted that France's President Macron was recently pleading with President Xi of China for direct investment.
He was trying to shrink France's ballooning trade deficit with China. They are essentially begging for foreign capital to plug the holes.
And this desperation is why those frozen Russian assets, despite the enormous risks, look like the only viable option for funding things like aid to Ukraine.
It is. The EU can't just issue more sovereign debt to fund these operations. The consensus among financial experts is that doing so would immediately blow up the entire bond markets because of the existing sovereign risk and high debt loads. They're financially paralyzed.
And just as Europe hits this financial wall, the U.S. commitment, the gravy train, as some reports called it, has come to a screeching halt. The analysis shows a rapid and severe decrease in U.S. financial aid.
It's not just a slowdown, it's a near total cessation. I mean, look at the figures. The U.S. sent a massive $27 billion tranche of money to Ukraine in Q4 of last year.
$27 billion.
That dropped dramatically to only $500 million in Q1 of this year. And by Q2, the funding essentially stopped. Washington is functionally too broke to continue funding external conflicts at that kind of historical scale.
That seems counterintuitive given all the geopolitical rhetoric. Why is Washington pulling back so severely right now?
Washington's focus has become intensely domestic and fiscal. The U.S. government is facing its own severe fiscal crisis and massive borrowing requirements. The priority has shifted entirely to internal needs. So rebuilding domestic supply chains, massively funding the AI race, which is a noted financial black hole, and updating critical, decaying infrastructure and power grids across the U.S. Every dollar spent abroad is now viewed as a liability, not an investment in the domestic economy.
The fiscal figures in the U.S. are genuinely shocking. It really backs up the idea that this is a financial imperative, not just some political shift.
Oh, absolutely. The U.S. government's fiscal situation is unsustainable. In the first half of the next fiscal year, they are projecting they will borrow approximately $1.15 trillion from global investors.
1.15 trillion.
It's a $158 billion increase over the previous period. That level of debt issuance is massive. It creates a demand that dominates global financial markets. It means the U.S. must prioritize domestic spending and debt servicing over foreign aid. The U.S. gravy train has ended because its own economy is reaching a breaking point.
So this massive confluence of European desperation and American withdrawal, that's the pressure cooker that gives rise to these bizarre financial schemes we are now seeing.
Exactly. Since the ECB won't provide the legal backstop, the EU Commission has concocted a convoluted Plan B.
This is the reparations loan.
The reparations loan, a scheme that many analysts have derided as little more than a glorified payday loan. The plan, championed by the EU Commission, is to have financial institutions holding the frozen Russian cash balances move that cash into a new financial instrument. This new instrument then issues a loan directly to Ukraine.
And the payback mechanism relies entirely on an optimistic future.
Precisely. Ukraine only has to pay back the loan if and when Russia is paying reparations after the conflict ends. The EU is essentially forcing private financial actors to use the seized Russian cash as collateral for a loan, crossing the legal Rubicon now, and just gambling that Russia will be forced to repay the full amount later. It's financial engineering of the most convoluted sort.
Meanwhile, Russia is not just passively observing this, they're preparing the harshest response possible.
They've confirmed this publicly. Former President Medvedev warned that using the assets is tantamount to war. And the Foreign Ministry confirmed they have a pre-drafted, detailed plan for counter-confiscation of Western assets, which they intend to execute instantly if the EU proceeds.
And they've already demonstrated the mechanism.
They have. By seizing and selling Western-owned companies like Carlsberg, placing them under temporary state management.
So who are the sitting ducks still operating inside Russia?
The easiest targets are the major EU banks that, despite all the warnings, have kept operations running because the profits are just enormous. Specifically, analysts point to large EU banks like Raiffeisen, which still holds over 10% of its total assets inside Russia.
They've already been fined, haven't they?
Billions in fines, and now they face the credible threat of total confiscation. But there's a larger, more damaging threat mentioned in the source material. Russia declaring a debt jubilee.
A debt jubilee. Can you quickly explain what that means in this context?
It means a mass cancellation of debt. In this case, Russia would unilaterally cancel all obligations, hundreds of billions owed to EU creditors by Russian companies. This would be a devastating financial counterpunch aimed squarely at European institutions and investors who still hold Russian corporate bonds or have outstanding loans.
And here is the final, really remarkable twist to this story. The conflict isn't just West versus Russia, it's US versus EU over who gets the spoils. Our sources indicate the US is actively lobbying the EU to block their reparations loan plan. Why?
Because the US has its own idea about how these assets should be used. And they want the entire benefit, not just a share. The US is operating from a position of trying to orchestrate an end to the conflict and is already eyeing the Russian assets for their own long-term gain. This is detailed in reports around their own 28-point peace plan.
And what does that U.S. plan propose for the frozen assets specifically?
It involves utilizing $100 billion of the frozen money for rebuilding and investing in Ukraine, but with a major stipulation. The U.S. would get 50% of the profits generated from that investment.
50%.
And critically, the remainder of the assets would be invested in a separate U.S.-Russian investment vehicle for joint projects, potentially focusing on securing critical supply chains like rare earths and strategic minerals.
So if Europe implements their convoluted loan scheme, it completely messes up Washington's ability to use the assets to secure supply chains and get a 50% cut of the rebuilding profits.
It puts the Allies in direct conflict. The final takeaway from this entire mess is that the West agrees the assets should be carved up, but the U.S. is maneuvering to ensure it receives the maximum benefit. And that is creating deep and public friction between Washington and Brussels. Meanwhile, Moscow is simply waiting for the first move to deploy its most damaging counter-seizure measures.
This entire deep dive reveals how the effort to financially corner Russia has backfired really spectacularly. Europe is now trapped between an independent central bank committed to the rule of law and an increasingly fiscally strained, domestically focused U.S., all while facing decades of litigation and serious economic backlash from global trading partners whose trust has been irrevocably damaged.
It's a perfect case study. Geopolitical actions always have immediate and often irreversible financial consequences that extend far beyond the initial target. They end up damaging the institutions of the actors themselves.
So what does this all mean for you? Since both the EU and the US are maneuvering fiercely to seize or utilize these Russian assets, and remember, Moscow is mentally prepared for their loss, what does this conflict, not just between the West and Russia, but between the US and the EU over the spoils, reveal about the future credibility of central banks and, most importantly, the security of sovereign debt globally? If the custody rules can be tossed out for a major power, what guarantee is left for any country holding